Hello everyone and welcome to the video 2.01. This is an explanatory video for test 2. I really want you to look at this explanatory video seriously because I touch on some of the important points that is related to the test. So I will just start and so we are talking about the 8th of September, which is 22. The test will be on 1 p.m. So please be on time. The structure of the test, as I explained to you, it's 25 multiple choice questions. Some of them, of course, true and false. It will be 50 minutes and we will give 5 minutes for readings. Now the test will be mixed between calculation and theory because those weeks that is covering the test, which is week 3, week 4, and week 5. You are only responsible about those 3 weeks. And tentatively, I am making 7 questions, 8 questions, and 10 questions here for week 5. Now, please look at the lecture slides, tutorial solutions, and workshops. And I will tell you, because we didn't cover some of the workshops, like workshop 3, we had a test, and workshop 5, we just cover some, tool everywhere, and I give you the answers. But I want you actually to look at the workshops, and I uploaded workshop 3 for you here as additional notes. You can look at the recorded lectures if you haven't by now, but I suggest you start with the tutorials, the workshops, and then if there is anything, you go to the recorded lectures. As usual, you will have a 2-all test with the solutions. And as I told you, I am giving you also with the notes, the additional question, which is the workshop additional question, which is week 3. Actually, this is the workshop with the solution. Now, let's start with week 3. Now, week 3, as we talked, the purpose of the week 3 or securitization and loan sales is to manage the interest rate risk. That was the main purpose, but we can use loan sales and securitization as the financing vehicles and also decrease other risks. Now, when we go to the technical issues, you should be sure and we have questions in the tutorial about the loan sales, whether we are talking about participation and assignments, and now we call this sale with recourse or sale without recourse, with recourse or sale without recourse or without recourse. And this is actually reflect the issue of participation and assignment. So selling without recourse is the assignment, and selling with recourse is the participation. And I think we have some questions where we can question number 1 in the tutorial, please look at that, where we can sell without recourse or without recourse. Now, when we come to securitization, we talked about those 3 vehicles and in the lecture slides and in the recording. But in the tutorial, we talked only about those 2, which is question, I think, 4 and 5. So there is no calculation here. There was some calculation here. The test will be no calculation for CMO. But you should be aware of the, what does it mean, CMO? Because CMO is tranches, and we should know that there is tranche A, tranche B, tranche C, tranche R, and tranche Z. And this is in terms of the quality of the payments. Now, we also, if you look at the week 3, actually we are talking about benefits, and this is actually week 3, and this is securitization and loan sales. And I think we talked here at the last slide about the benefits and cost of securitization. We also talked about, see, this is very important slide, and I want you to be sure of. There is something called prepayments. And these prepayments is the amounts of those borrowers who decide to pay before their loans matures. And they pay because of what? Because of the drop in the interest rate. So if they take a loan sale, if they take a loan, a mortgage loan, a housing loan for 8%, and the interest rate now dropped to 4%, usually they will prepay and clear the old loan and take a new loans. And they can do it either by paying the loans or by transferring the loan to another person. So if they transfer the loan to another person, we call it assumable mortgages. In this case, there is no prepayment. It's just the loan will be transferred from one person to other person, and there is no effect on the pool. Because the problem is when we issue the securitization, we have to have the payments on time. Now, if there is prepayments, yes, they will pay us all the money now, but the problem is there will be no future payments for this one, for this loan that has been prepaid, and then the payments to the investors for the loans and for the coupons will be less. And this is why they come for the CMO. So I want you to understand that there is something called assumable loans, and there is something called prepayments. Assumable loans are those loans that transfer from one person. So I'm in KL, and then I have a housing loan here and the house, but my job has been transferred to Penang. So I go to Penang and make a loan there. So I make a loan there and give the loan here to some other buyers. So the other buyers will assume the payments, so don't affect. That's what I want you to understand here in this issue. Now, let me go to the, this is the assumable loan and the cost and benefits and the prepayment functions. Please understand those issues because they are very important when we have securitization. If there is prepayment, actually that will be disturbed. Now there is another issue which is actually in workshop 3, which is the wall. Now the wall is, I want you to, because I'm uploading for you the workshop. So the workshop is here, and we have so many questions, and they are uploaded here with the all 2 tests. But at the end, there is a question about this one, about the wall and how we calculate the wall. If you look here, maybe here, if you have these payments, the expected principal payments, and you have to calculate the time times the price. In this case, you will have what we call the time is the principal. This is the principal actually. Then in this case, if you want to calculate the wall is actually the total time over time principal, which is this amount. And then you have to divide it by the expected principal payments, which is 60. Now this loan, instead of paying 4 years, it will be 3.35 years. This is how we calculate the weighted average life of the loan. So I want you to be aware also of this. I think there is one question to calculate the wall. If I give you this information, just calculate it. This is maybe the issues for, this is the issues, all the issues I think for loans and securitization. The rest you can look at it in the tutorial. Now in week 4, which is the bank performance, we talked about so many things. And the first thing you should be aware that there is a difference in the balance sheet structure between a business firm and a financial institution. And we said, actually, we cannot compare because the assets are different, the liabilities are different, and the revenues are different because of this financial intermediation. But if we have another ratio like the ROE is the net income over equity. You can compare that ratio. The other ratios you cannot compare. So please be aware of that the difference is coming from the financial intermediation, and there is a difference in the balance structure between the two, but sometimes you can actually use the ROE and consider that. You can consider the ROE as if you want to compare between the bank, financial institution, and a business firm, because the ROE does not include those three items, which is actually different, which is the assets, liabilities, and revenues. So when we come to the leverage ratio, we cannot compare. All those ratios in the ROE model, we cannot compare, except for the ROE, we can compare actually. Then we talked about the quantitative and qualitative analysis. And we said this is maybe different, but the main function of the qualitative analysis is actually to validate the financial performance. So we have financial performance, like the ratios and the financial ratios, whether they are external and internals. Those ones, if you are doing well in in the financial performance, then the qualitative one, like the reputation, the confidence in the market, the perception of the investor, the perception of the stockholders, the perception, the compliance with the regulator, all of those is qualitative one. And if they are okay, this one should be okay. So one of the main function of qualitative is actually to validate. Then we talked about the bank performance process. You can look at this, it's not a big deal, but this is one of the issues. It's a process and it's one of the slides. But the DuPont model, please be, the DuPont model is actually, we talked about it, DuPont model, or which we call it the ROE model. We talked about it too much and the slides. And so if I give you the ratios, you can calculate any ratio of whether the ROA, whether the LM, whether the AU, whether the PM, which is profit margin or asset utilization or return on assets. And we have some questions in the tutorial. So if I give you a balance sheet, whatever, you can calculate one of those ratios and it should be pretty straightforward. We talked about other ratios, this ones, and you should be aware. And I think we covered this in the tutorial, the workshop. We talked about liquidity. We talked about liquidity risk. We talked about credit risk. And if I give you numbers, you can differentiate. You can say whether the bank is performing well or not well. Okay. I think this has I mentioned, and this is actually related to this issue. This is one of the issues which we talked about, I think, and this is related to it. Now, I said we can compare actually the ROE. We can compare any other ratios like the ROE ratio. We can compare that one, yeah. Now, in week 5, we talked about bank capital planning and bank capital planning. Look, in bank capital planning, we have a workshop. We have also we have a workshop and we have a tutorial and we have the slides. Now, in the workshop, specifically for this week, I give you the answers for the workshop, but also we run some of the exercises on Pool Everywhere. Now, Pool Everywhere, if you attended that workshop, that's fine. You can find it in your history. I want you to look at those questions which we did in the Pool Everywhere. There are few. I think we did 2 competitions, but also if you cannot find them, that's fine. Even if you have seen them, I am uploading the recording. Look at the recording. Please look at the recording of workshop 5. Look at the recording. There are some questions there. Maybe they will be in the test. Those questions are coming from the pool everywhere exercise, which we did in the workshop. Now, how bank capital different from equity capital? We talked about this, types of capital. We talked about, the Simple ratio. We talked about tier 1 and tier 2. And I think we finished this. We talked about it in the tutorial. We talked about it in the slides. And you should be aware of that. Now, also, when we talked about the considerations, if you remember the model, and the model is talking about when we decide on a capital, we have to decide on all those issues. There are actually 10 ratios. Those are 10 considerations. This is 4, and this is 6 of them. So if you add them up, there will be 10 considerations. But when we come to the model, we only concentrate on the tax benefit, and we talked about the regulatory compliance. It's not about Basel III. It can be about Basel III, but it's actually about the compliance. If you look at the model and that quadratic equation and linear equation, we have talked about it. You should be aware of that very well. So you know how to, if I give you, what is the optimum debt, you can tell me what is the optimum capital, which is the optimum capital in this case would be the target capital. Now, we talked also about the modeling. And when we talked about the modeling, we talked about 2 important models, which is this one and this one. But they are different. This one, when we calculate it, depends completely on the internal capital. Which means how much the ICGR will tell me how much the increase in capital. So you can increase your assets accordingly to stay on target. Please understand those words, to stay in target. And I discussed one of those questions in the pool everywhere in the recording of week 5. So this is, if you increase the capital, then you increase the asset, so you start in target. Assuming that you are in target from the beginning, okay? Now, the AGM is a different issue, which is you have to have a percentage of increase. Now, if you are assuming, or if you are planning to have an increase in your total assets, then you have to consider what is the internally capital is giving you, which is the return earning. The rest you have to get it from outside. And when we talk about external capital, we are talking about these 3 sources. So you have to raise the capital from those 3 sources. Now, also when we talked about the either the AGM or the ICGR, we know that most of the internal capital is coming from the internal the income, and the income is divided into 2 issues. The income, as you know, the income, when we have the income of a bank, it will go to 2 sources. Either we pay dividends, or either we make return earnings. So if we are talking about return earning, which actually will be capital, we want that if we are growing, we need the return earning to be as much as we can. So which means we will decrease the dividends. But actually, it's not an easy decision to do that. So you have to look at those theories. Now, when you consider how much dividends you should pay, you should look at those theories. And I want you to be aware what those theories are saying, which one are arguing for more dividends, which one arguing for less dividends, which one doesn't care. So this is how actually your shareholders think. So you have to see how your shareholders think and think about the dividends. You just not can increase the dividends. So if there is a question about what those theories are, what do they argue for, I think you should be aware of that. So I think I have talked, this is actually related to the dividends. As I told you in bank capital, now most of those, except for this one and this one, which is the corporate, this one and this one, this one and this one, we argue for less capital and more debt. The rest actually are arguing for. So this one, if you are talking about this one and this one, arguing for more capital. The only ones that argue for less capital is these two. So we should be aware of, if this is 10 considerations, how many considerations of them argue for more capital and how many of them argue for less capital. Please understand the difference between the two models. One will depend on the increase of the total assets based on internally generated capital, which is this is actually depends on the increase, and the other one is and the other one actually will ask for external capital. So, and they will depend on internal capital, and they have to top up. If they have, for example, the IGM, they will depend on the internal capital. And if the ratio that was generated less than the target, then you have to get external capital. And I told you, this is the sources of the external capital. So I think it's very straightforward. The exercises are actually here, and I think you should look at this workshop 5 recording. That's all for now, and I want to thank you very much. I will see you on, as I told you, on Tuesday at 1 p.m. I wish you the best, and please be on time. Thank you, and see you then, and also see you in the tutorial. If you have any questions, just send me, and I will try to answer them as soon as possible. Thank you, and goodbye for now. Bye.